So what's the biggest mistake investors typically make? Well, if we understand this, we may be able to understand how we can eliminate that in our own investing and potentially do better. Howard Marks spoke about this in a recent podcast.
Lately, people have been asking me, what is the biggest mistake that you've seen, or what is the mistake that people make most often? And I think it is that once the market is moving in one direction, that it will always continue to do so. In truth, regression toward the mean, or the correction of excesses, is much more dependable than continued movement in a straight line.
Why do things reverse?
Mark says that investors have a tendency to think emotionally when they see their investments decline. This is a feeling of pain they get when they see their account balances shrink in a down environment, and that causes people to fall prey to what we would call cognitive bias. And that's where your emotional feeling of pain, seeing your account balance decline, overrides your logical faculties and your ability to step back and say, well, while it's down right now, that doesn't necessarily mean it's always going to be down. Well, first of all, you need to have a critical vision about your investments. If you invest in just a random stock, you don't know if it's going to zero or not. So first of all, you have to have something that has a really strong outlook fundamentally. And then secondly, you need to have a mindset that's capable of enduring some of these fluctuations. The nature of investments is that they're going to go up and down. And the movements can be shocking and significant at times. And one has to be prepared in order to accept the downswings that they may see happen in their accounts. And in those times, maintain a long-term outlook if their investment still looks strong, to hold to that belief and thereby give themselves an opportunity to benefit from the recovery and the cyclical nature of the investments. So I wanted to take a closer look at this, and one of the things that I was looking at was the JP Morgan Guide to the Market. You can see in this slide from the Guide to the Market, there is an outline of historic market volatility, and you can see that the average decline in any year for the S&P 500 from its peak to the bottom of the decline since 1980 is 12%. And so that should be a very significant piece of information to investors to know that if they are going to be invested in the stock market, it is very likely that once annually, the market's going to visit them a 12% drawback from its peak. And so that's something investors need to be aware of. The good news is that in roughly 80% of these scenarios, when the market declined by 12% or more, the market actually finished the year off its lows. So by the end of the year, it had recovered at least a little bit from its peak drawdown. Now the market was like a rubber band. The more you stretch it, the faster it's going to come back up. And so there's no obviously guarantees in investment, but I think some of this data and historic perspective is kind of determining what the most intelligent approach is for investors. If you found this video helpful, I hope you will subscribe to our channel for more video adventures ahead. If you are interested in getting input on your financial planning, please contact me at Parkmount Financial. Our website is www.parkmountfinancial.com. There you can subscribe to our newsletter and even request a complimentary introductory meeting with myself as a certified financial planner. So until next time.